This is a point where you smooth things out. I'm looking at a 3-month moving average of 147,000. I guess that stabilizes the shock that we saw last month.
Yeah, I think so. The Fed statement last month and the minutes suggested employment uncertainty. And as you smooth things out for 3 months at, close to 150,000, I think that does it. I mean, the unemployment rate went up to 4.9, did it not? The wages increased by a 0.1 as opposed to a 0.2. And so, I think things are not as hunky-dory as 280,000 might suggest, but, back to a normalized 150,000. I think it's nothing to get excited about.
It may not be something to get excited about, but does it get anyone interested in what Janet Yellen and company are going to do? Does this change the calculation of when they might move at all for you?
No, I don't think so. They still have Brexit to look into the eyes, the whites of the Brexit's eyes, I guess. They have problems with Italian banks, or the Fed doesn't, but the ECB and the EU do. The problems with UK property mutual funds, there's a sense of illiquidity in markets, and the Fed, of course, is very obsessed and concerned with markets to the extent that there's discord around the world. I think the Fed stays where it is. They've wanted to raise interest rates. They did it once. I think they want to have us believe that they'll raise several times and therefore have a pretty positive yield curve, which will help banks and insurance companies. But for the most part, I don't think this changes much.
Well, just to clarify, your call is for how many rate moves this year?
Well, the market only calls for a half over the next 12 months, and the 12 months beyond that, another half. So 12 basis points each. That's the market. I think they raise once or try to raise once, and if they continue to get employment numbers like this, and if they can get those wages up, then perhaps they'll have their chance later in the year. I think they really do want to raise rates. I think some of them, like Bullard and Evans, have a sense that they need higher interest rates in order to balance out the savings versus investment element in the economy.
And the markets come back right now. We had stronger yen, and then we had weaker yen off the shock of the report, a good report with good revisions, and then we've got the yen coming back again. Bill Gross, without question, in our lifetimes, this is the most price-to-perfection bond market we've ever seen. Has your day-to-day life changed when you see yields? I mean, the yield goes from 139 to 141. These are shocking yields and shocking bond valuations. What are you doing day to day within this milieu?
Yeah, I agree with you. I don't think it's priced to perfection. I'll change that a little bit if you will permit me, Tom. It's priced to absurdity. And so, one knows that $12 trillion worth of sovereign bonds are in negative yield space. One knows that in Germany that the ECB can't really buy 40% of German bonds because they're yielding less than 40 basis points. One knows in Japan that almost everything, including the 40-year JGB, is at 0 or less. And so it's an absurd market, and what do you do is the question. Well, you obviously don't buy those bonds. That's something that German banks and insurance companies have to buy because they got to put their money somewhere, and so you look for substitutes and some type of certainty. The trick in this business, Tom, is to buy the highest return relative to the risk. I would say every asset class is at risk. The question is which one is at less risk. And
right.
I think my dominant premise is that central banks will continue to do what they do, despite the fact that I disagree with it. And if that's the case, then the volatility of central bank positions, the volatility of the policy rates around the world, in the developed world, will stay relatively constant. And so you want to take advantage of that by selling optionality around it. That would include buying mortgages. That would include selling outright right options that would include, basically upping your income from something like 1.4 on a 10-year to something like 5 or 6% on an annual basis.
And to do it Janus Capital jargon alert, folks, when Mr. Gross sells options, those derivatives, that brings in an income stream to his fund to keep him in chips. Bill Gross, if I look at into the weekend and into July, into the second half, is Bill Gross looking at Janet Yellen's American world, and for that matter, a troubled Europe, is in equilibrium, or are the disequilibriums so great that you need to be vigilant for exogenous shocks?
Well, yeah, I think one must be prepared. And how fat is that fat tail? It's hard to say, but it doesn't approach a black swan, but maybe a gray swan. There are problems everywhere. I talked about the UK property situation. We know the Italian banks are now asking for a bailout as opposed to a bail-in. We're not quite sure what's going on with China, but I observed that the Chinese stock markets, basically stay level throughout the entire night, each and every night, and so one has to suspect that something's going on there. I simply think, that there's a potential problems almost everywhere in a highly levered world, and that's the key, Tom. Okay. When you have a highly levered world, then almost anything can set it off.
Okay, I know Mike McKee wants to get in here with a lot of questions. Let me ask one more question before we go to my colleague. Bill Gross, Ambrose Evans Pritchard wrote a brilliant article overnight in the Telegraph about China exporting their deflation over to us. Is Janet Yellen running a non-orthodox policy because she's got to accept the disinflation from China and the rest of a troubled economic world?
Well, I think she does, and certainly if she continues to talk about raising interest rates, that would make it even worse. Yes, China, as they devalue by 6 or 7% over the last 7 or 8 months, maybe 10% annualized, is exporting deflation, and some investors don't quite understand how that could be the case, but it basically means that we can buy Chinese goods much cheaper, that it basically erodes our manufacturing base as it becomes less competitive, et cetera, et cetera. And so China exports their deflation to the rest of the world. Yellen, how does she fight that? Well, she certainly doesn't fight it with a stronger dollar and with an interest rate hike. And so, I think that tempers her behavior certainly to some extent.
Mike, this is just a key insight, I think. We're so Europe. Guess what? China has a little bit to do with it.
China will come back certainly into the news. Bill, I want to ask you about the price action today, and it's very similar to what we have been seeing in recent weeks with a flattening of the curve going on. Does the yield curve tell us much anymore at this point? In theory, we should be seeing more signs of inflation and the long end not go down as much as the short end is going up.
Yeah, I think it does, Mike. I think, the old standard, and that's the problem with the Fed and with the old-time investors, not that I'm not 72, but I think the old standard is that when the 10s to 2 curve, flattens out and becomes 0, then we've got problems in terms of a recession. Well, it's come down from about 250 to now, I think it's around 78 or 80. I don't know at the minute where it is, but that's a significant flattening, and it's the process of flattening, the momentum of flattening that makes the difference, and especially one has to adjust for the highly levered world. It's a different world when we're highly levered and the yield curve is flat at 0 as opposed to 78 basis points. I think the Fed, basically has been tightening for the last 2 years. They've taken off quantitative easing. They've basically watched the curve between 2s and 10s or 10s and 30s flatten, and basically that restricts financial institutions in terms of their profitability, regulation, all of that in combination. A flattening yield curve is not good, and even where it is, it suggests the potential for slower growth and recession down the road, especially alongside a very strong dollar, which over the past 12 months has increased by 20 to 25% to the rest of the world.
Bloomberg's Mark Gilbert, over the last 24 hours, writing a very provocative piece, gotten a a lot of comment suggesting that the Fed and other central banks are making a mistake by keeping rates too low, that if rates were to rise, it adds to bank profitability, makes them more likely to make loans, and given the demographic shifts, elderly people, not you, of course, but other people who are
Watch
getting
yourself,
up there,
Mr. McKee. It'll never come on again.
Either, but they're spending. They're not making any money right now because they can't earn anything on their savings, and that you get more bang for the buck that way than by holding rates down and trying to influence the spending behavior of millennials.
Yeah, I think so too, although that's not a proven model, and that's the problem. Central banks work off of 20, 30, 40-year models like Taylor and Phillips. Yes, I think it's commonsensical, and that's where common sense needs to enter the equation. Certainly there would be negatives in terms of mortgage rates. Certainly there would be negatives in terms of stock prices, as that discount relative to the Gordon dividend discount model, basically lowers prices, everything else being equal. But let's face it, the real problem going forward is savings and the ability to earn on savings. It's impacting insurance companies, pension funds, banks in terms of their profitability and their margins. It's impacting the common citizen in terms of saving for education and retirement. Yes, it was time to raise interest rates 12 to 18 months ago. I still think it is, but I don't think it's going to happen.
You mentioned pension funds. This is what's happening now in the market's got to be a disaster for them. What do you do if you're a pension fund manager?
Well, it is a disaster. What you do is you try and jimmy the rules a little bit, and they do that. They change the rules and make the the relevant rate a little bit different in order to stretch out the inevitable, I suppose. But you try to cut benefits. That doesn't work very well. We've seen that happen in Detroit and Chicago. The budgets get hung up as you try to reduce benefits, and so it becomes a long dragged out battle in terms of reducing the marginal profitability or the marginal survivability of a pension fund. Most of them, on average, are like 80% funded because of the lower interest rates and because their durations haven't matched the durations of their liabilities. It's a real problem going forward, and one of the ways to do it is to raise interest rates. There are other ways, as I just suggested.
Well, if that doesn't happen, is this going to unleash a wave of buying as pension fund managers capitulate and just try? Is this going to be a fight over 30s out there?
Well, that's the buzz in the papers, right? I don't know whether that's true or not. It's hard to immunize your portfolio, with a 10-year at 1.4%. Your compatriots would question your sanity because, just a few years ago it was at 3%, and a few years before that it was at 5%, and now you're going to immunize at 1.4%. So, take it to the extreme in terms of negative interest rates. Would an Allianz in Germany immunize their portfolio with half of their interest rates in negative space? That's Alice in Wonderland world if I've ever seen one. So, I don't think there's a rush now. I would hope not. The real problem would be a rush to higher yielding, riskier assets that provide a semblance of return relative to liabilities.
Bill, you mentioned the property companies in the United Kingdom, Brexit, and of course an illiquid investment. They've got to stop redemptions from their various funds because real estate is rather illiquid versus the game that you play every day. I think what all of our viewers and listeners want to know from Bill Gross, including the institutional elites like Madame Lagarde warning yesterday with the IMF, is when this Alice in Wonderland world unwinds, will it unwind along smooth, predictable, dampened reaction functions, or will it unwind with ugly jump conditions where there's real damage? Which way do you go in that debate?
Well, policymakers are trying to make it smooth, are they not? And they have
Agreed.
for the last 5 or 6 years with monetary stimulation and changing in rules at the last minute. You know, right now we've got Germany basically suggesting that bail-in could be bail-out for Italian banks under special circumstances. We've got the UK property mutual funds basically changing their unit value or the worth of the fund by 15 or 20% overnight, simply to prevent money coming out, which to me is incredible. It makes an investor say, "What is my money worth?" It was worth. Go ahead,
Bill. I want to interrupt. There's a small-time bond manager out on the West Coast. Mike, what's his name? Gunlock. Remember him? There's a guy named Gunlock, Bill Gross, who's on West Coast time with you. And he focuses on Deutsche Bank as a proxy for the European banks. Would you consider the position Deutsche Bank is in, or if they have to structure cocoa hybrids for the Italian banks, to be the kind of jump condition that leads to real instability?
Well, it could be. We've known that Deutsche Bank is a weak link in the banking system in Euroland for a long, long time, and we watch the stock price as it sinks to 11 and 10, and we know that there must be a hole there somewhere. We know that Deutsche Bank is over hundreds of trillions of dollars of derivatives, some of which they've closed out, but we don't know what's left. And so, the Deutsche Bank was the bastion of German banking for such a long time, but then it got caught in the rush to derivative madness, and now we see the problem. So certainly, certain Italian banks, Deutsche Bank, the lack of confidence in policymakers as they change the rules in order to support them. All of these things, reduce confidence in markets because investors know that artificial prices are the theme of the day.
One thing, Bill, that you've been comfortable with in the recent quarters has been Mexico. If I see a Brexit knock-on effect and all the contagion in Europe going over to a Mexican peso from 18 to a weaker 19, who knows where it's going, does even Bill Gross have to stop doing normal procedures because of the butterfly effect of Brexit in Europe over to an emerging market proxy like Mexico?
Yeah, I think that's very prescient, Tom. I think Mexico is used as a proxy for emerging markets. It's the best of the emerging markets. It actually has half the debt relative to GDP of the United States, but nonetheless, Mexico and the peso, basically take it on the chin when things start to go wrong. But what does that mean in terms of policy? Well, we saw last week that the central bank raised interest rates in order to, basically support the peso to some extent. And so, yeah, you can expect some volatility there. I would point out that the Mexican 10-year tip, the linker, the inflation-adjusted bond, basically yields 3% real as opposed to 35 basis points in the United States. That's a huge spread, and so you can adjust for the credit quality, but it's a value absent a rush to safety.
We've seen a lot of people rushing into corporate bonds as everybody in the world tries to get some sort of yield here. Is that a smart move at this point? Are people taking too much of a risk, using it maybe as a proxy for sovereigns?
Well, Mike, it's a quick formula. You figure out what the spread is. Let's take high yield at 450 basis points. You figure out what the annualized defaults will be in the recoveries. Let's say 4% with a recovery of 50%, and so that takes 2 points off the 4.5, so that leaves you 2.5%, relative to your treasuries. That's not a bad deal, but it's not the deal that investors think they're going to get. And if we have problems times elsewhere, like we've been talking about, then certainly those spreads are going to widen out. I think it's obvious that when interest rates are at zero or negative, that everything's tied together. You know, the thigh bone and the knee bone and the hip bone and junk bonds and stocks and negative interest bonds are all tied together in some way. And so you must assume, I think, that the high yield bond area is artificially priced and at risk under certain circumstances. I wouldn't buy them.
Well, effectively,
Matter of fact,
go ahead.
Matter of fact, I'm short them. I'm short them.
Across all categories of corporate, or just high yield?
No, you know, there are CDX, which is an index of high-yield bonds, and an IGCDX, which is an index of investment-grade bonds. And, you know, those are derivatives that are easily traded. The IGCDX trades at about 80 basis points. The high-yield, you know, basically at about 425. And so, yes, when you buy protection as opposed to sell protection, which I've done, that's the same as shorting, then you're giving up that carry, but you're looking for a widening of spreads, and I think ultimately that's what happens in both of those markets.
With the cost of money for banks trading at basically effectively 37 basis points, are corporate bonds the channel for monetary policy now?
Well, they certainly are beginning to be with the ECB, are they not? The stocks are the asset class of the day with the Swiss National Bank that we just found out. They have $500 billion worth of stocks around the world, including Apple and Johnson & Johnson. To me, that's staggering. We've known that the Japanese buy stocks, but I never knew that the Swiss National Bank bought stocks. You know, it's almost like a sovereign wealth fund. And so, you know, this entire market is distorted by cash flows that never have been.
Oh, Bill, you know, I look at Swiss franc and I think of Bob Sinch at Amherst Pierpont, who's been looking at sterling Swissy as a proxy for safe haven versus all going on in the United Kingdom. Bill, I think all of our world would like to know, the Bloomberg surveillance world would like to know what you were thinking in the drama of the Brexit vote. What were you thinking as you saw the United Kingdom shift to leave versus the presumed remain?
Well, I was watching that overnight, and what I was watching was that, you know, I had some options on U.S. Treasuries, both calls and puts, and, you know, that initially the U.S. Treasuries were declining in price and declining too much, but then all of a sudden, you know, as Brexit was winning, Treasuries went up and were going up too much. So, you know, when you sell volatility, you don't want to sell as much volatility as happened on that night. And it was a long night for me. It turned out very well, but you know, that's the problem with a sudden change. There's so many positions. There's so much leverage currency-wise, as you point out, almost you know, every 5 minutes. Tom, in your program, you're very currency-related, and I think that's good. There are huge currency positions that have to be unwound and rebalanced. There are huge positions in terms of credit and treasuries. There's huge positions across bunds and JGBs and U.S. Treasuries, and so, you know, all of this, when something happens, you know, it induces lots of volatility and a lot of loss taking on one side and profit taking on the other. It's not the way capitalism should be run. It's a casino as opposed to a Midwestern farm.
You've been listening to Janus Capital's Bill Gross with Tom Keene and Michael McKee on Bloomberg Radio. So just to recap some of these major job headlines that we've seen, the June number coming in at 287,000 jobs. You strip out those Verizon workers, you're still looking at